What's up, YouTube? It's Joe Catalpalia sitting on the couch making some money investing in real estate online. Today I'm going to be talking about a property on the Lofty platform again, but actually what I want to do is give you a warning about um, one of the main traps that I see on this platform in particular, and I think that it is, it's not apparent on the surface, or it might be apparent. It's one of the first things I talked about is the strange debt structure that they use, but it might not be apparent how it could have a negative impact on you. If you're someone who just logs into the site, looks at the current yield, and makes an investment. And I think that that's what a lot of people are doing, and they're ignoring most of the other numbers. And I want to show you why I think that. So looking at this 49 Banbury Lane, one of the co-owners on the site that actually, I think is doing a great job on his properties mentioned, hey, look at this one passed me up today. This is the highest priced property on the site. So I was like, oh well, then I've got to take a look at that and see what's going on. It's a single family home, 3 bed, 2 bath. It's in Florida, a market that I like. I looked at the market, I looked at the flood maps. I'm not going to go through all that due diligence today. Um, I think that there's a lot of reasons to like the home at the right price. I noticed, it's only been on the platform a short time, maybe 5 or 6 months, and its price is at $70. I started at 50. Um, that's already concerning, right? Assuming that price was accurate to begin with. But so it made me, start to dig in, like, okay, what's going on? So, and we know, you know, um, we're going to use these this is the numbers of outstanding tokens. This is the original price that it came to the market at. And so I'm down here. So with those total tokens, the initial offering, this is at $50 each. If you look at the current price of the tokens, which is when I'm recording this video, $7 or $70.33. So this math will change, later on or at a different time, but it showed, that equates to a current price of 507,572. I mean, that's a huge jump from the initial offering, which was just 5 or 6 months ago. So, okay, maybe we got a great deal then, right? So we'll first look at the financials tab here, which shows the total investment. They gave a value of the underlying asset price at, 359,200. All right, well, let's see what the appraisal said at that point. This is the appraisal that was done at that time. It was at 342. So already, we've got a decent disconnect. And these tokens, I was looking at the Discord. I went back in time looking at when this was first put up, and these tokens just got snatched up, even though it was, um, it's being paid as a premium to the what the appraised value said. So okay, maybe they think the appraisal is low. Let's look at some other things. Looked at Realtor. Okay, the current co-owner bought it for 350 in 2023. So okay, we added about 10K over that year. Maybe that's true, maybe that's not. A lot of markets didn't really do that. Let's see if we can find what Palm Coast, Florida did. I didn't actually do this before, so let's take a look at this. Palm Coast, Florida, Zillow home prices. This is let's see. Oh no, there's our. Let's see. Usually we can get it to give us just like home price trends. Uh, There's our homes for sale, homes for sale. Okay, maybe. Oh, yep, here we go. Right there. So over the last year, prices have actually gone down in that market. Now, this isn't always accurate because, it's telling you like median home price. And so if smaller homes are sold and whatnot. So, okay, it's not such a damning number, but it is, makes me worry. Okay, we went up in value. That says it should have gone down. Um, Realtor's current estimated market value is 349. I looked on Zillow, they didn't give us one. They did actually give us a rent estimate that worried me a little bit too, because it's currently rented at 2,000. That's not so far off, and maybe that's right, but let's just move on. Redfin says 335. That's in line with that, decrease in pricing from the 342, right? So nothing about this, looking at homes.com, I don't know how they get this really low value, but their high end is below where we're at. And so all of that valuation, just made me worry a little bit. I started looking at the financials themselves, and I know people buy these properties a lot on here strictly for their yield, and they're clearly not paying attention to much else. And so I want to dig into this and figure out, like, what's their calculation for their cap rate? How are they getting such a good deal? And so they're showing a really low cap rate, right? 4.97. That's a really low cap rate, and I just recreated that here, right? But then whenever I say that this is sort of fluffy numbers, and I don't really call this a real cap rate, it's because normally I'd at least add in a vacancy and collection loss, and so I just put a 5% in there. And I usually put in some allowance for repairs and maintenance, and I just put 5% in there. Now that doesn't mean those two numbers are the right numbers, but to have some sort of projection that's realistic, both of those things are going to happen. You're going to have repairs and maintenance. You're going to have vacancy collection loss. And so if you put those in, that in this cap rate is based on not the current price. That cap rate is calculated, and this is something I wanted to double check when I was doing this, and it turns out that it is the case, is this cap rate is based on, you can see when I highlight it, this initial offering price, right? That's how we recreate that 4.97. So if you use their income numbers and the current price, actually at a 3.54 cap, which is, I mean, shockingly low. I can't imagine wanting to buy anything that low. And then if you use, my numbers where I have just a little bit of allowances in there, which I don't think those are extreme at all, you end up getting a 3 cap, 3.06. So this is, I think it's like just really crazy to me that somebody would spend that much on this property without some other reason. So I was trying to figure out, like, is there something else going on? And again, how are they paying that yield, right? But the way that they do it is, currently there's 297,000, and I think it's actually 415. But this is what happens when you just multiply it by the $50 each. But so there's that much debt on the property, and so the co-owner who brought the property to the market just pays the cost of that debt. Out of his own pocket, and presumably he, what I've been told in the past is they need to hold enough tokens, or so that Lofty is comfortable that they can pay the debt out of that plus their management fee. So he's managing, so he's collecting the 2,400. But so I looked at, that's the mortgage or the appraisal I pulled up. This is the note, so this is what they're actually paying, the mortgage amount. So that's the debt amount, 5%, and so they're paying 1239.23 a month. I actually didn't use that payment. I just multiplied it out. Curious how close that is, right? So let's see. I just did 5% times the total amount, but 1239 what? 1239.23. 12, that's 12. Oh yeah, right on. Okay. So it is, it's just calculating the 5%, and that's one of the, it's nice to see that math still works, right? So they're breaking it down into 12-month payments. But so if you look at, my estimate here, and actually let's throw it in here too. It's just going to screw up that yield. I don't think so. I think I have it going through. Okay, good. And then just this. And so, if you hold that requirement to pay that interest into the property, with my estimates, you only have $673 in cash flow left. if you use theirs, you have 3,000. Like again, I think you have to have some repair and maintenance, some vacancy collection loss because it's just the reality of the business. Um, you know, that's just if you look at those cash on cash numbers, I mean, this is not a property I would ever recommend a client buy here in town. And this is with a 5% interest rate. I mean, five, and this is 5% interest only. If we had any sort of amortizing payment here, you would just absolutely have a negative cash flow. And so it's really hard to understand, um, what's going on here, right? Like I get, okay, so this 20% yield is just taking that NOI, and so like it does fluctuate monthly because they're just showing, whatever they actually made this month, and so these are the only allowances they had. If there was no vacancy and there was no R&M that month, it doesn't come out. And so then they annualize it. So that's where these numbers came from, is like annualizing the last month every time. So if you take that, um, and then you divide it by, and what it is the total equity tokens that are outstanding times the current price. Yeah, that's how you end up with their yield, right? And I think that uh, that is it makes sense, right? It's not wrong, and that's what they're actually paying out per token. But so the only way that that's happening is this interest payment is getting picked up by the co-owner who brought it to the platform. Um, Even if he owned all of the outstanding equity tokens, he'd barely be cash flowing. But I know from looking at the wallets that I mean, maybe he has multiple wallets, right? I think that's possible, but there's a whole bunch of different owners, so there's no way. It doesn't seem unless he's like more than half of these wallets, that cash is coming from somewhere other than the property. And so that's a little concerning because it's an owner that owns a bunch of properties. And, maybe Lofty's done some due diligence and they are like, oh, he's got a whole bunch of cash and I'm not worried about it. Um, but me as an owner in this specific property, uh, I'm definitely, I would be concerned, right? Like the property itself is not creating that yield, right? Like, I mean, if it was owned free and clear, and you were, so I guess I should have done this one, right? So, like, if you look at that yield, well, I mean, if it was owned free and clear, this is your yield, right? You're getting 5.97%, and really, I think it's probably, well, and at the current price, it's 3.54 or 3.06, depending on how, whose numbers you trust, how you want to look at it. And like I said, I mean, I'm just plugging some numbers in there. I don't necessarily think it's exactly what's in there or what's going to happen, but I think you need to have something. So over time, there's no amortization happening, but at some point in time, that mortgage is either going to get paid off. Something has to happen with it, right? Because the co-owner that's making that payment, it doesn't, there's no clear benefit to maintain this structure, right? And one of the things I've heard some of the employees or one of the employees at Lofty say is, well, they just got all this cash from selling their equity, and that's what worries me, right? It worries me that this is a way, that a co-owner was able to cash out onto the site, get paid for most, if not all, of their equity. They are getting a management fee, but they're having to pay this interest amount. And so depending on what their personal financial situation is, I question, do they, I would be concerned if they have the ability to continue to pay that, when the property itself really would struggle to pay it, right? And so so my my worry is that this is really an artificial yield that is not going to be, maintained in the long run. And if that is accurate, if it can't be, well, I just don't see how it can, right? And so I don't know. I actually messaged one of the other, um, one of the other owners on here that I think is pretty bright and good with the numbers, and I'm asked him if I was missing something, and I'm actually a little hesitant to put this video up because it just makes it seem like, I mean, I just can't even understand why somebody would buy this, right? Like, unless the only thing you're doing is saying, "Oh, 20% yield, let me buy that." But it's just not sustainable, right? There's at a certain point, there's not enough benefit to the current, the co-owner that's making that debt payment. Um, and this is just the interest. There's no amortization happening, so they're not getting new tokens. They're not getting to dilute anything. They're just carrying that payment, every month, and it's not really clear um, why they would want to do that. I don't know. I guess that's my main concern, right? Is it's very, um, if they were doing that, if this property was continuing to sell around the $50 token price, I would think, I'd be less concerned. I mean, yeah, the 4% yield or 4 or 5, it's not great, but like then it starts to look, y- you know, I mean, it's not completely unreasonable, but when when it's trading up all in the 500,000s, and it does look like the co-owner made some sales of tokens significantly over the 50. I don't know if any of them were at the 70, but I think there were some 60s or $65 sales. And so getting cashed out of his equity at a price that's, higher than the what the market value looks like it should be. I don't know. It just seems like there's something. It's tough to understand what's in it for him, why he'd continue to want to make those interest payments, other than like having, got to sell out that initial equity. But more importantly than his motivation, because that's not really what I'm questioning. That's not like I think, oh, this is a nefarious person doing something wrong. I just don't see how you can own the property that's barely supporting itself, um, but pay out this really high yield uh, and want to pay a huge premium for it, right? Like, so my worry would be, you buy this at $70, you get your yield for a little while, and then either the yield craters or, well, I mean, the yield would have to disappear right before the value does, because there's not a the people that buy these tokens, if they're getting paid, they normally just hold on to them. But let's say the co-owner that has has this huge mortgage payment wants to put up a vote to sell it, and it's selling at a price that anybody that paid $50 tokens, would make money, but everybody who bought it in the 70s is going to lose. Like, I mean, that's a real worry from my perspective. And so, I guess overall, my concern is, yes, it's a very high yield, but it's just the creation of financial engineering. Like, I want the underlying asset to support the value that I'm paying, and I also want the underlying asset to be what's supporting my yield, right? I don't want this yield, or at the very least, for there to be a yield that I'd be happy with, afterwards. So, I always often talk about, like, your yield is going to approach your cap rate over time. And so I'll give you an example. So, like, uh, well, let's see. That's another one where, well, oh, but I think they're calculating weird right now because they did the cap rate. That's not a good one. I'm going to give you a different one. If I didn't just break it. Oh, I did. Are we still recording? We're recording, but it is frozen. We'll see how that works. That's really interesting. I haven't had this happen before. Usually it goes the other way. Usually the recording freezes. Oh, but it looks like we're good, right? Are we good? Right. Let's go to the marketplace. Well, I'm so curious how that part of the video turned out just now too, though. Um, so like, for example, yeah, oh yeah, all of these are going way down because, Well, this is a good example. Yeah, not 88 Madison. The 90 Madison, I think that the accounting is weird and it's screwing up the cap rate because it's um paying down some debt, and I think they're taking it out of the cash flow, which is just not appropriately. Example, okay, this one's got a huge it's got a huge yield, right? Like your rental yield 23, um, 27. I think this is projected. This is when you're using your I don't know why these two numbers are different, but one of them I think uses the market price and the other one might use the other. But if you go down and you look at your cap rate, and this is the initial cap rate, but so let's use that. Even if it gets diluted a bunch by the higher price, you still have a very high cap rate. And so if I'm getting a high yield, I want it to be justified by the income that's being thrown off by the property. If it's being created by this structure, it's a very fragile structure. And so my worry is, okay, I make a 20% return for 6 months, and it's not really 20 because it's only 6 months, right? I got 10%. But all of a sudden it cracks, or maybe it's a year from now. And so, okay, so then it just becomes like, oh, how long can it last? And I'm still getting paid, before, okay, all of a sudden now it's not working anymore. I'm now selling it. Instead of a $70 token, I have a $35 token. That's my, and I don't really worry about that with a property like this, where the property itself has a very high yield relative to the valuation. Although, I didn't buy into this one at this price. I bought, but at something over $50, I'm okay with it, but I'm not, I'm still, when they get pretty high, I've been avoiding that. But so that's all I wanted to, I really just wanted to give you that warning today, is that, when you're seeing these really high yields, you should take a little time and figure out, where are they coming from? How sustainable are they? If it doesn't look like the property is able to throw off that income with the debt that's in place, or I mean, like this, it doesn't even look like it. Well, it couldn't even if you use these numbers, right? If you used an amortizing payment instead of just a pure interest payment, so like if he's forced to refinance and rates are anywhere where they are today, it's going to be upside down unless rents have grown quite a bit. So that's the warning. That's my big concern. Um, am I right about it? Am I missing something? I think it's perfectly possible that I am. Why am I going back to here? I didn't mean to do that. I'm just fumbling around as usual. So, like I said, I make a lot of mistakes. It's certainly just because it looks really scary to me. It doesn't mean that you shouldn't, invest in it. Whether or not it's right for you is a completely other story. But, this is just something that I'm looking at when I'm doing my due diligence. This was just one that, like, really tough for me to figure out what's going on. Um, yeah, I mean, that's, it's really all I have to say about that for today. Wouldn't mind if you liked and subscribed the video. I'd never ask, I don't ask nearly as much as I'm supposed to. Also, there's links in the description below. If you're new to Lofty, to get a free token on there, maybe pick a different one. That's not investment advice. That's just saying maybe. If you are, there's also links for Mogul and Ground Floor, two other sites that I've got a lot of video out there about. But again, for any of them, do your own due diligence. Understand that I put them there to share the free money that I got, but also that if you do invest in those, I do get some kickback from them, right? Most of them, they give me $50 if you do something. You have to sign up and then put some amount of money in. So just full disclosure there. Um, yeah, this was a crazy one for me because it is just really hard to understand, what's going on. And so if I do figure it out, I will let you know. But I mean, there hasn't even been any sort of vote, to switch it to Airbnb or to do some other thing where we're going to get some additional income. I mean, I'm really just at a loss uh, as what people are thinking at that $70 purchase price. I mean, I'm just they're only looking at that yield and not thinking at all about like how sustainable that is. I mean, that's what it appears to be to me. Um, in any case, until next time, I'm going to keep making mistakes so that you don't have to.